Question 1. What is the primary distinction between facultative reinsurance and treaty reinsurance? A. Facultative reinsurance involves the automatic transfer of all risks, while treaty reinsurance requires individual assessment of each risk. B. Facultative reinsurance is negotiated on a case-by-case basis, while treaty reinsurance covers a broad portfolio of risks for a set period. C. Facultative reinsurance only applies to life insurance, while treaty reinsurance applies exclusively to property and casualty insurance. D. Facultative reinsurance is generally used for high-frequency, low-severity risks, while treaty reinsurance is suited for low-frequency, high-severity risks. Answer: B. Facultative reinsurance is negotiated on a case-by-case basis, while treaty reinsurance covers a broad portfolio of risks for a set period. Explanation: Facultative reinsurance involves the transfer of individual risks where each risk is assessed and accepted on a case-by-case basis. It provides flexibility but may require more negotiation. In contrast, treaty reinsurance involves an agreement where the REIT covers a portfolio of risks, typically over a set period, without needing to evaluate individual risks for each one. This automatic transfer simplifies the process but comes with less flexibility. Question 2. Which of the following methods is commonly used to price reinsurance contracts based on the loss history of the ceding insurer? A. Risk-based pricing. B. Loss ratio method. C. Excessive loss method. D. Premium calculation method. Answer: B. Loss ratio method. Explanation: The loss ratio method is commonly used in reinsurance pricing and is based on the ceding insurer's loss history. It compares the premiums charged by the insurer to the actual claims paid, expressed as a ratio. This method helps reinsurers gauge the risk level based on the past performance of the ceding insurer and is often used to determine an appropriate premium. The risk-based pricing method on hand involves pricing based on the risk profile of the underlying portfolio of risks rather than just historical loss data. Question 3. Scenario-based. Mr. Thompson is a reinsurer who has entered into a treaty agreement with an insurer to cover a portion of their auto insurance portfolio. After a severe storm, the insurer submits a large number of claims related to vehicle damage. Mr. Thompson must now assess whether these claims qualify for recovery under the treaty. What is the first step Mr. Thompson should take in this situation? A. Immediately pay the claims, as the treaty automatically covers all vehicle damage. B. Assess the claims individually to determine if they meet the specific terms and conditions outlined in the treaty agreement. C. Deny the claims because the damage occurred due to a catastrophic event. D. Wait for the ceding insurer to pay the claims and then review whether they align with the treaty's pricing terms. Answer: B. Assess the claims individually to determine if they meet the specific terms and conditions outlined in the treaty agreement. Explanation: Mr. Thompson must first assess whether the claims meet the specific terms and conditions outlined in the treaty agreement. Even under a treaty agreement, not all claims are automatically covered. There are likely specific conditions related to coverage limits, exclusions, or claim types that must be verified before proceeding with payment. The reinsurer should ensure the claims align with the scope of coverage provided in the treaty and may require additional documentation or verification. Question 4. In reinsurance, what does the term ceding refer to? A. The process where the reinsurer accepts the risks from the primary insurer. B. The practice of the primary insurer retaining all the risk and not transferring it. C. The transfer of risks by the primary insurer to the reinsurer. D. The underwriting process where the reinsurer assesses the risk. Answer: C. The transfer of risks by the primary insurer to the reinsurer. Explanation: Ceding refers to the process where the primary insurer transfers some or all of its risks to a reinsurer. This is a key feature of reinsurance agreements, allowing the primary insurer to reduce its exposure to large losses. The term is used to describe the action of transferring part of the insurance policy's risks, with the reinsurer assuming responsibility for those risks in exchange for premiums. Question 5. What is the primary purpose of is surplus share treaty? A. To provide coverage for only high-severity claims that exceed the primary insurer's retention. B. To allow the reinsurer to assume proportional share of each risk above certain threshold. C. To reinsure only catastrophe events, such as natural disasters. D. To cover the administrative costs associated with the reinsurance agreement. Answer: B. To allow the reinsurer to assume a proportional share of each risk above A certain threshold. Explanation. A surplus share treaty is a type of proportional reinsurance agreement where the reinsurer assumes a proportional share of each individual risk above a set threshold or retention level. This means that for any claim exceeding the retention limit, the reinsurer will cover a predefined portion of the loss based on the agreed terms. This the ceding insurer to spread risk and reduces their exposure to large claims. Question 6. Scenario-based. Ms. Rodriguez is reviewing a new reinsurance treaty and notices a clause that specifies the excessive loss coverage. Based on her understanding, which of the following best describes what this coverage entails? A. The reinsurer will cover losses above specific threshold but only for catastrophic events. B. The reinsurer will cover all losses, regardless of size, once the retention limit is reached. C. The reinsurer will pay for all claims related to the portfolio of risks, including the first dollar of loss. D. The coverage is triggered once losses exceed the agreed retention limit, covering the excess amount. Answer. D. The coverage is triggered once losses exceed the agreed retention limit, covering the excess amount. Explanation. Excessive loss reinsurance refers to an arrangement where the reinsurer covers losses that exceed a predetermined retention limit or deductible generally related to a catastrophic or large event. The ceding insurer retains responsibility for losses up to the retention limit, and once that is exceeded, the reinsurer takes over. Covers the excess amount. This type of coverage is typically used to protect against large, infrequent losses. Question 7. Which of the following is the most accurate description of the solvency ratio in reinsurance? A. Financial metric that measures the ability of an insurer to pay policyholder claims over set period. B. Ratio comparing the reinsurer's assets to liabilities to determine its financial stability. C. Formula that calculates the total value of the insurer's reinsurance premiums. D. The ratio of claims paid to premiums received, indicating the profitability of the insurer. Answer. B. A ratio comparing the reinsurer's assets to liabilities to determine its financial stability. Explanation. The solvency ratio is a financial measure used to assess the financial health of an insurer or reinsurer. It compares the company's assets to its liabilities, providing an indication of its ability to meet future obligations to policyholders and claimants. High solvency ratio suggests the company is financially stable. 1. Ratio may indicate financial risk. This ratio is particularly important in reinsurance as it reflects the reinsurer's capacity to pay claims, especially during times of large losses. Question 8. Which of the following is not typically a component of a reinsurance treaty agreement? A. Insuring agreements detailing the risks covered. B. Exclusions that define the risks not covered under the treaty. C. A detailed underwriting process for each risk ceded. D. Termination clauses outlining the conditions under which the agreement may be ended. Answer. C. A detailed underwriting process for each risk ceded. Explanation. Reinsurance treaty agreements generally include insuring agreements, exclusions, and termination clauses. However, they do not typically involve a detailed underwriting process for each individual risk, as reinsurance treaties generally cover a broad range of risks, not specific individual cases. The underwriting process for each risk ceded is more common. Facultative reinsurance agreements where each risk is individually assessed. Question 9. What is a key characteristic of retrocession in reinsurance? A. It refers to the process of an insurer transferring risks to a reinsurer. B. It is the process where the reinsurer transfers some or all of its risks to another reinsurer. C. It involves the ceding insurer retaining all the risks but sharing premiums with a reinsurer. D. It is the transfer of claims settlements from the primary insurer to the reinsurer. Answer. B. It is the process where the reinsurer transfers some or all of its risks to another reinsurer. Explanation. Retrocession is the practice where a reinsurer, after assuming risks from a primary insurer, transfers a portion of those risks to another reinsurer. This is a form of risk management that helps reinsurers spread their own risks further, especially in the case of large or catastrophic exposures. Retrocession can help maintain stability by preventing a reinsurer from becoming overexposed to certain risks. Question 10. In the context of reinsurance, what is the function of a reinsurance broker? A. The broker directly assesses the claims and determines the payment amount. B. The broker acts as an intermediary to help the ceding insurer and reinsurer reach an agreement. C. The broker solely manages the reinsurance claims settlement process. D. The broker establishes the financial reserves for the reinsurer. Answer. B. The broker acts as an intermediary to help the ceding insurer and reinsurer reach an agreement. Explanation. A reinsurance broker serves as an intermediary between the ceding insurer and reinsurer, assisting in negotiating the terms and conditions of the reinsurance agreement. They provide valuable market insight, help identify appropriate reinsurers, and ensure that both parties agree on the coverage, pricing, and terms. Do not typically handle claims assessments or manage financial reserves. These functions are usually performed by the ceding insurer and reinsurer, respectively. Question 11. What is the primary difference between facultative reinsurance and treaty reinsurance? A. Facultative reinsurance involves reinsurance of a single policy, while treaty reinsurance covers a portfolio of risks. B. Facultative reinsurance is used only for large catastrophic risks, while treaty reinsurance is used for smaller risks. C. Facultative reinsurance is mandatory for the ceding insurer, while treaty reinsurance is optional. D. Facultative reinsurance is less expensive than treaty reinsurance. It involves fewer risks. Answer. A. Facultative reinsurance involves reinsurance of a single policy, while treaty reinsurance covers a portfolio of risks. Explanation. Facultative reinsurance involves the transfer of individual risks, often on a case-by-case basis, where the reinsurer can decide whether to accept or reject each risk. In contrast, treaty reinsurance involves a broader agreement covering multiple policies or a portfolio of risks, automatic cession of certain risks that meet the treaty terms. Facultative is more selective, while treaty reinsurance is typically more comprehensive and continuous. Question 12. What is the function of a quota share treaty in reinsurance? A. The reinsurer assumes a fixed percentage of each risk, sharing both premiums and losses on a pro rata basis. B. The reinsurer assumes all risks above a certain threshold in exchange for a higher premium. C. The ceding insurer retains all risks, while the reinsurer only receives a fee for the service. D. The treaty provides coverage only for catastrophic events and excludes regular losses. Answer. A. The reinsurer assumes a fixed percentage of each risk, sharing both premiums and losses on a pro rata basis. Explanation. A quota share treaty is a form of proportional reinsurance where the reinsurer assumes a fixed percentage of all risks covered under the treaty. This means the reinsurer shares both the premiums and losses on a pro rata basis, allowing the ceding insurer to spread risk evenly across a portfolio. This approach typically used when the ceding insurer wants to reduce its exposure to certain lines of business. Question 13. Scenario-based. Mr. Davis is analyzing a reinsurance treaty and notices a clause that specifies the excessive loss coverage. What does this coverage imply? A. The reinsurer covers only the first dollar of loss and leaves the ceding insurer responsible for any excess. B. The reinsurer will cover all losses up to a certain limit, but not beyond that amount. C. The reinsurer will pay for losses above the specified retention limit, covering only the excess amount. D. The ceding insurer retains all losses, while the reinsurer only covers administrative costs. Answer. C. The reinsurer will pay for losses above a specified retention limit, covering only the excess amount. Explanation. The excessive loss reinsurance refers to an arrangement where the reinsurer covers losses that exceed a predetermined retention limit. This type of reinsurance is typically used to protect the ceding insurer from large catastrophic losses, with the reinsurer stepping in to cover the amount above the agreed threshold. The ceding insurer retains responsibility for losses up to the retention level. Question 14. What does the term reinsurance recoverables refer to? A. The total amount of reinsurance premiums that have been paid to the reinsurer. B. The amount of premiums paid by the reinsurer to the ceding insurer for the coverage provided. C. The amount of claims paid by the reinsurer to the ceding insurer for losses incurred. D. The amount the ceding insurer expects to recover from reinsurers for claims paid to policyholders. Answer. D. The amount the ceding insurer expects to recover from reinsurers for claims paid to policyholders. Explanation. Reinsurance recoverables refer to the amounts the ceding insurer expects to recover from reinsurers for claims that have been paid to policyholders. This amount typically represents the reinsurer's portion of the claims liability, which will be reimbursed according to the terms of the reinsurance agreement. These recoverables are important for the ceding insurer to manage cash flow and maintain solvency. Question 15. What does the term retrocession refer to in reinsurance? A. The process of the ceding insurer transferring risk to another insurer. B. The transfer of risks from one reinsurer to another reinsurer. C. The act of A reinsurer retaining all the risks and not transferring them. D. The payment of claims from the primary insurer to the policyholder. Answer B. The transfer of risks from one reinsurer to another reinsurer. Explanation: retrocession refers to the practice in reinsurance where a reinsurer transfers a portion of its risks to another reinsurer. This can occur when a reinsurer wants to reduce its own exposure to certain risks or manage its capital requirements. It's a common risk management tool that allows reinsurers to share large or volatile risks among themselves. Question 16. What is the primary goal of risk-based pricing in reinsurance? A. To set prices for reinsurance based solely on the insurer's administrative costs. B. To calculate premiums based on the expected level of risk the reinsurer is assuming. C. To offer competitive pricing that disregards the underlying risk. D. To establish a fixed premium rate for all types of reinsurance agreements. Answer B. To calculate premiums based on the expected level of risk the reinsurer is assuming. Explanation: risk-based pricing is a method used by reinsurers to calculate premiums that reflect the level of risk they are assuming. The higher the perceived risk of the portfolio or individual policies being ceded, the higher the premium charged. This method takes into account factors such as claims history, loss potential, and exposure to catastrophic events, ensuring that the reinsurer is adequately compensated for the risk they undertake. Question 17. Which of the following best describes the claims reserves in reinsurance? A. The funds set aside by a reinsurer to pay for future claims made by policyholders. B. The amount of premium paid by the ceding insurer to the reinsurer. C. The total amount of recoverables expected from retrocession. D. The calculated value of reinsurance treaties in force at a given time. Answer A. The funds set aside by the reinsurer to pay for future claims made by policyholders. Explanation: claims reserves are funds set aside by a reinsurer to cover the estimated future liabilities arising from claims. These reserves are essential for maintaining solvency and ensuring that the reinsurer has sufficient capital to pay future claims, especially for long-tail lines of business where claims may be reported years after the policy issued. They are a crucial part of the reinsurer's financial management process. Question 18. What is a key factor in determining the solvency ratio of a reinsurer? A. The total amount of premiums received by the reinsurer. B. The comparison of the reinsurer's liabilities to its assets to ensure it can meet future obligations. C. The value of reinsurance treaties the reinsurer is underwriting. D. The quality of claims documentation provided by the ceding insurer. Answer B. The comparison of the reinsurer's liabilities to its assets to ensure it can meet future obligations. Explanation: the solvency ratio is a key financial indicator that measures reinsurers' ability to meet its future obligations. It is calculated by comparing the reinsurer's total liabilities to its total assets. High solvency ratio indicates that the reinsurer is in strong financial position and is capable of paying claims when rise, whereas low solvency ratio may signal financial instability. Question 19. What is the role of the New York Department of Financial Services (NIDFS) in regulating reinsurance companies? A. The NIDF determines the claims settlements in reinsurance agreements. B. The NIDF is responsible for overseeing the licensing, solvency, and financial stability of reinsurance companies. C. The NIDF mediates disputes between ceding insurers and reinsurers. D. The NIDF sets the premium rates for all reinsurance agreements. Answer B. The NIDFS is responsible for overseeing the licensing, solvency, and financial stability of reinsurance companies. Explanation: the New York Department of Financial Services (NIDFS) plays a key regulatory role in overseeing the reinsurance industry. Its responsibilities include ensuring that reinsurance companies meet the necessary licensing requirements, maintain adequate solvency, and operate in a financially stable manner. NIDFS also enforces compliance with state laws and regulations to protect policyholders and ensure market integrity. Question 20. What is the purpose of loss adjustment expenses in reinsurance? A. To cover the administrative costs incurred by the ceding insurer in issuing new policies. B. To provide funding for the reinsurance company's operational costs. C. To cover the costs associated with investigating, adjusting, and settling claims. D. To determine the amount of premiums owed to the reinsurer by the ceding insurer. Answer C. To cover the costs associated with investigating, adjusting, and selling claims. Explanation: Loss adjustment expenses refer to the costs incurred by a reinsurer to investigate, adjust, and settle claims. These expenses include costs such as legal fees, expert opinions, and other administrative costs directly related to the claims process. Is a significant factor in determining the overall cost of claims and must be accounted for when calculating the reinsurer's financial position. Question 21. What is the purpose of an annual statement filing for a reinsurer? A. To summarize the reinsurer's financial position and operating results for regulatory review. B. To provide the reinsurer's claims history to potential ceding insurers. C. To outline the reinsurer's pricing strategies and underwriting guidelines. D. To provide an assessment of the reinsurer's risk portfolio for investors. Answer A. To summarize the reinsurer's financial position and operating results for regulatory review. Explanation. Annual statement filings are a key regulatory requirement for reinsurers. These filings provide comprehensive summary of the reinsurer's financial position, including its balance sheet, income statement, and details about its risk portfolio. The information is used by regulators to assess the reinsurer's solvency, health, and compliance with applicable laws and regulations. Question 22. In reinsurance, what is the primary focus of catastrophe risk evaluation? A. To assess the impact of climate change on insurance premiums. B. To estimate the potential losses from large, low-frequency events like natural disasters. C. To evaluate the administrative costs of claims settlement. D. To determine the potential for fraud in reinsurance claims. Answer. B. To estimate the potential losses from large, low-frequency events like natural disasters. Explanation. Catastrophe risk evaluation focuses on identifying and estimating the financial impact of rare but high-severity events, such as earthquakes, hurricanes, and floods. These events can cause significant losses for insurers and reinsurers. Proper evaluation helps in determining adequate coverage and pricing for catastrophic risks, ensuring that the reinsurer is prepared for such large-scale events. Question 23. What is the typical purpose of a stop-loss reinsurance arrangement? A. To provide the ceding insurer with coverage for risks that exceed a certain threshold. B. To limit the reinsurer's exposure to a specific maximum loss amount, protecting both parties from catastrophic events. C. To allow the ceding insurer to recover premiums paid from the reinsurer. D. To cover only the losses that occur due to fraud or misrepresentation. Answer. B. To limit the reinsurer's exposure to a specific maximum loss amount, protecting both parties from catastrophic events. Explanation. A stop-loss reinsurance arrangement is designed to protect the reinsurer from catastrophic losses by limiting the total amount of losses the reinsurer will pay out. Once the losses exceed a predetermined threshold, the reinsurer takes over the excess. This type of reinsurance is often used in cases where ceding insurer is dealing with high-frequency, low-severity claims and wants to limit its exposure to significant losses. Question 24. What is the role of reinsurance intermediary? A. To provide the reinsurer with market insights and claims adjustment services. B. To assist in the placement of reinsurance contracts between ceding insurers and reinsurers. C. To directly underwrite reinsurance policies on behalf of both insurers and reinsurers. D. To negotiate the pricing of reinsurance policies on behalf of policyholders. Answer. B. To assist in the placement of reinsurance contracts between ceding insurers and reinsurers. Explanation. A reinsurance intermediary acts as a broker between the ceding insurer and reinsurer, facilitating the placement of reinsurance contracts. They help find appropriate reinsurance coverage, negotiate terms, and secure the best terms for both parties. Intermediaries are important in ensuring that the ceding insurer's needs are met and that the reinsurer takes on the appropriate level of risk. Question 25. In a proportional reinsurance arrangement, how are premiums and losses shared? A. The ceding insurer retains all premiums but cedes a fixed percentage of the losses. B. The reinsurer assumes a fixed percentage of both premiums and losses based on the agreed treaty. C. The reinsurer assumes 100% of the premiums and losses. D. The ceding insurer and reinsurer share premiums and losses based on the number of policies written. Answer. B. The reinsurer assumes a fixed percentage of both premiums and losses based on the agreed treaty. Explanation: in a proportional reinsurance arrangement, the reinsurer shares both premiums and losses in proportion to the percentage agreed upon in the treaty. This means that if the reinsurer agrees to take on 30% of the risk, it will receive 30% of the premiums and pay 30% of the losses. This approach helps the insurer to distribute risk while also maintaining a portion of the risk exposure. Question 26. What is a non-proportional reinsurance arrangement? A. An agreement where the reinsurer takes on a fixed percentage of the premiums and losses. B. A type of reinsurance where the reinsurer only assumes losses above a certain threshold but not premiums. C. A reinsurance contract where both the ceding insurer and reinsurer share all losses equally. D. A reinsurance agreement where the ceding insurer retains all risks and only pays fees to the reinsurer. Answer: B. A type of reinsurance where the reinsurer only assumes losses above a certain threshold but not premiums. Explanation: in a non-proportional reinsurance arrangement, the reinsurer only covers losses that exceed a certain threshold known as the retention limit. The ceding insurer retains responsibility for all losses up to that threshold. Non-proportional reinsurance is often used to protect the ceding insurer against catastrophic events, with the reinsurer assuming liability only for losses beyond the agreed retention. Question 27. What is meant by the cession in the context of reinsurance? A. The payment made by the reinsurer to the ceding insurer for underwriting services. B. The transfer of risk from the ceding insurer to the reinsurer. C. The amount of profit the ceding insurer retains after reinsurance is applied. D. The percentage of premiums retained by the reinsurer. Answer: B. The transfer of risk from the ceding insurer to the reinsurer. Explanation: the cession refers to the process of transferring risk from the ceding insurer to the reinsurer. When an insurer cedes a portion of its risk, it essentially transfers the responsibility for certain claims or losses to the reinsurer in exchange for a premium. This helps the ceding insurer reduce its exposure to large losses and improve its financial stability. Question 20. What is the primary purpose of the reinsurance premium paid by the ceding insurer? A. To cover the costs of claims paid by the reinsurer. B. To compensate the reinsurer for taking on part of the risk associated with the policies. C. To pay for the administrative services provided by the reinsurer. D. To ensure that the ceding insurer maintains its market position. Answer: B. To compensate the reinsurer for taking on part of the risk associated with the policies. Explanation: the reinsurance premium is the amount paid by the ceding insurer to the reinsurer in exchange for taking on a portion of the risk. This premium compensates the reinsurer for assuming responsibility for the risk and potential claims, which helps the ceding insurer to manage its exposure and financial stability. Question 29. What is reinsurance arbitrage? A. A practice where reinsurers manipulate premiums to gain an unfair advantage in the market. B. A strategy where a ceding insurer chooses reinsurance contracts with higher retention limits to minimize its premium payments. C. The practice of taking advantage of pricing discrepancies between primary insurance and reinsurance markets. D. The process of reinsurers providing excessive coverage at high premiums to maximize profits. Answer: C. The practice of taking advantage of pricing discrepancies between primary insurance and reinsurance markets. Explanation: reinsurance arbitrage occurs when a ceding insurer exploits pricing differences between the primary insurance market and the reinsurance market. This can involve structuring reinsurance agreements to take advantage of more favorable terms, such as lower premiums or higher coverage, in order to generate financial benefit. This practice is typically done to reduce the ceding insurer's overall costs or to enhance its profitability. Question 30. How does the excessive loss reinsurance protect the ceding insurer? A. It provides coverage for losses that exceed a specified amount, shielding the ceding insurer from large catastrophic claims. B. It allows the ceding insurer to retain responsibility for all losses below a specified threshold. C. It provides a fixed amount of premium for all claims, regardless of loss size. D. It covers only the operational costs associated with claims settlement. Answer: A. It provides coverage for losses that exceed a specified amount, shielding the ceding insurer from large catastrophic claims. Explanation: excessive loss reinsurance is designed to protect the ceding insurer from catastrophic losses by covering losses above a specified retention limit. Once the ceding insurer's losses exceed that threshold, the reinsurer takes over responsibility for the excess amount. This arrangement helps the ceding insurer its exposure to significant or unexpected losses, ensuring its financial stability in the event of major claims.